$20 million. That is your carried interest from a single fund cycle. 1 decade. One bet on a company nobody believed in during a Series A with a $9 million pre-money valuation. You weren't the smartest person in the room when you made that call. You weren't even sure it was the right call. 7 years ago, you were reading 200 pitch decks a month and had no authority to write a single check. You were a filter. Now you are the fund. Level 1 the filter. You are 24 years old. It is 8:14 a.m. and the Notion queue already has 31 new decks. Your desk is a standing desk you never stand at. Your salary is $85,000. After taxes and rent in a city where $85,000 is considered a starter wage, you have $1,400 a month left over. You came from consulting. You left because you wanted to be closer to the companies. You are not close to the companies. You are close to their PDFs. The job, as it was explained to you on your first day, is to protect the partner's time. You are a pre-filter, a screen. You read, assess, and pass up or pass on. In a given month, you will review somewhere between 180 and 230 decks. You will refer perhaps 8 to a partner. Of those 8, perhaps 1 will result in a first call. You will not be on that call. The first rule you learn is not written anywhere. You learn it by watching what gets passed up and what gets buried. The rule is this: narrative travels faster than numbers. A founder who can tell you in 2 sentences what changes if they win is more dangerous than a founder with a perfect cap table and a mediocre story. You file this away. You don't fully understand why it matters yet. There are 3 other analysts. You eat lunch together most days. You talk about deals you've seen. You speculate about which ones will close. You are building taste without capital. That is the entire point of this level. Though no one says it that way. One Thursday, partner walks past your desk. He is on the phone. He laughs once, a short, controlled laugh, and says a number. The number is $340 million. He says it the way you'd say a street address. You look at your screen. You go back to the deck you were reading. You do not say anything, but you felt the distance between his number and your salary like a physical thing, like a change in air pressure, and you do not forget it. Level 2 the sourcer. You source now. That is the word. You source. Your compensation is $155,000 base, plus a small carry allocation that won't vest for 8 years and may never be worth anything. You go to conferences. You attend dinners in the private rooms of restaurants you could not afford on your own. You hand out business cards that say the fund's name on them, and founders treat you with a specific kind of calculated warmth because you represent the fund without being the fund. And everyone in the room knows the difference. You meet a founder at a seed stage event in San Francisco. She is building infrastructure tooling for climate data pipelines. The market is real. The timing is unclear. You have a 40-minute conversation, and you leave thinking she might be one of the best technical founders you've spoken to in 2 years. You write a 2-page internal memo. You use phrases like category defining and asymmetric upside. The partner who reads it asks 2 questions, sits on it for 3 weeks, and passes. No explanation beyond, not our thesis right now. You learn the second rule here. Conviction is not the same as permission. You can believe in something completely and have no mechanism to act on it. The gap between your judgment and your authority is the entire shape of your current life. You start keeping a list. Companies you flag that got funded elsewhere. You don't show it to anyone. You update it every few months. By the time you leave this level, the list will have 14 names on it. 3 of them will be worth over $1 billion. Level 3 the principal. You lead deals now. You sit in the room, not to watch, to speak. Your first independent transaction closes at a $28 million Series A. The company makes developer tooling. You pushed for the check. You defended the valuation. In the partner meeting for 40 minutes against 2 people who had been doing this longer than you'd been out of college. The check went through. That company will later raise a Series B at a $190 million valuation, and you will feel something. You weren't prepared for, not pride exactly. Something more territorial. You identified it. You protected it. It's yours in a way that compensation doesn't fully explain. You sit on two boards now. The first is straightforward. The second is harder. The second company is burning $1.1 million a month with 7 months of runway and a revenue growth rate that is not compressing the problem fast enough. In the board meeting, you ask about the sales motion. The CEO answers confidently. The CFO answers with slightly different numbers. The gap between those two answers is small enough that you could choose not to notice it. You notice it. The rule at this level is about losses. Everyone comes into venture thinking the job is picking winners. It isn't. The job is surviving the losses without letting them recalibrate your instincts towards safety. The funds that underperform are usually not the ones that miss the obvious winners. They're the ones that stopped taking the uncomfortable bets after a string of write-offs. You watch a colleague 2 years ahead of you pass on a Series A he would have funded 18 months earlier. He doesn't say he's being cautious. He says the market has changed. You understand the difference. Your carry is accumulating. It is a number on a spreadsheet. It is not money. It will not be money for years. You think about it the way you think about a forecast, relevant, but not real. Level 4, the VP. Your paper gains are $4.3 million. Nothing is liquid. You manage 2 associates now. Their output, their sourcing quality, their development as investors, that is yours to shape. One of them reminds you of yourself at that level, which makes you harder on her, not easier. You know what the habits that look like diligence can actually conceal. You've seen it in yourself. You try to teach around it without naming it directly. A founder you backed 2 years ago calls you at PM on a Tuesday. He needs a bridge. The Series B process collapsed. A lead pulled out at term sheet stage over a diligence issue that turned out to be real. You knew about the issue. You knew about it when you wrote the initial check, and you structured the investment around it, and you told yourself it was manageable. It was manageable until it wasn't. You spend 11 days working the bridge. You find the capital. The company survives. You do not tell the story the way it happened in any LP update. The rule here is about narrative control. The portfolio story you tell externally and the portfolio reality you manage internally are 2 different documents. You are not lying. You are selecting. Every investor does this. You understand now why they do it. You do not think about the distinction as often as you used to. You have stopped attending most events that aren't strategically useful. Not because you're too busy. The conversations aren't useful anymore. Your social world is narrowing to a corridor: founders, LPs, co-investors, a small number of operators you trust. Everyone outside the corridor has started to feel like they exist in a different tempo. Level 5, the partner. You raise the fund now. That is the job underneath the job. Your total compensation in a good year is $1.8 million. The majority of it carry that is still years from liquidity. Your base salary is $320,000. The number that matters is neither of those. The number that matters is $280 million, the target for Fund 3. You are 12 months into the raise. You are at $190 million. The gap between $190 million and $280 million is not a funding shortfall. It is the distance between a fund that performs and a fund that sets a benchmark. You pitch LPs in rooms that look like libraries, endowments, family offices, a sovereign wealth allocation team in Abu Dhabi that will take 3 meetings and 6 months to move $25 million. You are selling a 10-year relationship with a fund whose track record is real, but whose best vintages are still locked inside companies that haven't exited. You are asking people to give you capital based on what you believe will happen. You are a salesperson. You understood this intellectually before this level. You understand it operationally now. A portfolio company you championed is moving toward an acquisition. The buyer is a strategic at a $6.2 billion valuation. The founders want to take it. You want to take it. The problem is a co-investor who believes the company is a $2 billion business and wants to block the sale. He may be right. He may be protecting a position that looks bad if the exit is too low. You cannot tell the difference from the outside, and you are not entirely sure he can either. You are in 3 calls over 2 weeks trying to find a structure that works. The acquisition closes at $740 million. Your carry on that exit is $2.1 million. Realized? You feel something when the wire clears. It is not what you expected. It is quieter. You thought there would be a version of Arrival in that moment. There isn't. There is just the next deal, and the LP update, and the fact that Fund 3 still needs $90 million. Level 6 the GP. One exit changes your life. You knew this was theoretically true. Now is actually true. The company was a Series B investment. You wrote a $14 million check at a $95 million post-money valuation. The company went public at a $4.1 billion market cap. Your fund's stake, after dilution, is worth $310 million at lockup expiration. Your carry on that single position is $18.6 million net. You have been doing this for 11 years. This is the moment the structure was always pointing toward. Everything. Before this, the sourcing, the boards, the LP decks, the bridge financings, the PM calls was scaffolding. This is what the scaffolding was holding up. You run the fund now with 2 other GPs. You have raised $620 million for Fund 4. The LP base is institutional endowments, a handful of sovereign vehicles, 2 large family offices that have been with you since Fund 2. You know these relationships by name, by preference, by the specific anxieties each institution brings to a liquid allocations. You manage capital and you manage trust, and you have learned that the second one is harder to maintain than the first. You are making fewer investments than you used to. Each check is larger. A $22 million Series B lead into a company building AI infrastructure for regulated industries. The founder is 31 years old and has already returned capital to investors once. You do the deal in 9 days. At earlier levels, 9 days would have felt reckless. Now, it feels like the appropriate speed for a decision you made on day 3 and spent 6 days confirming. The trust circle is now fewer than 12 people. Not by design, by accretion. People fall away when the gradient between your lives becomes too steep to maintain. You don't close those relationships. They simply stop having the frequency and weight they used to have. You are not lonely in any way you would name. You are operationally singular in a way that has no social vocabulary. Level 7 the brand. You don't find the deals anymore. The deals find you. Your personal wealth is north of $140 million. The fund you anchor has $2.1 billion in AUM across 3 vehicles. Your name on a cap table changes the downstream fundraising trajectory of a company. Founders know this. They structure their series of processes to create competition for your check. Sometimes the competition is real. Sometimes it is theater designed to make you feel urgency. You have seen both enough times to know the difference and to understand that neither negates the underlying quality of the company, because the founders who can construct that theater are usually the ones who can construct the sales motion and the GTM and the narrative for the enterprise buyer who also needs to be sold. You spoke at a conference in London last month. You said 11 sentences about AI infrastructure and the defensibility of data moats. 3 of those sentences were quoted in 4 industry newsletters within 48 hours. You did not intend to move the conversation. The conversation moved because you were the one speaking. That is a different kind of leverage than carried interest. It is less legible and more durable. A founder comes to you 27 years old, previously a senior engineer at a company you backed 5 years ago. She is building in a space you have thought about for 3 years without finding the right team. The meeting lasts 35 minutes. You tell her you want to lead the round. She tells you she has 2 other term sheets. One is from a fund that would normally be your peer. You look at the terms. You don't match them. You make a different offer, a lower valuation, but a structure that protects her from dilution in the next round. In a specific scenario you've seen destroy founder economics twice in the past for years. She takes your term sheet. The other fund's partner sends you a note that is polite and opaque. You don't respond for 11 days. The rule at this level is one you can't say to anyone who isn't already here. The reputation is not the result of the returns. The reputation is the asset. The returns are the proof of concept. You spent 15 years building proof of concept. What you have now is something that compounds differently, not through IRR, but through surface area. Every founder who took your check and succeeded becomes a node. Every node generates referrals, co-investments, access to the next generation of technical talent, leaving those companies to start their own. You are not managing a portfolio. You are managing an ecosystem, and you are the fixed point it rotates around. Level 8 the loop. Somewhere in a co-working space in a city that never stops producing founders, a 23-year-old opens a Notion database for the very first time. The queue has 31 decks. Her title is analyst. She came from consulting. She left because she wanted to be closer to the companies. She has $67,000 in student debt and a standing desk she never stands at. She thinks this job is about pattern recognition. She thinks if she reads enough decks and writes tight enough memos, the system will reward the quality of her judgment. She doesn't know yet what the system actually rewards. She will spend several years finding out. The finding out is not a single moment. It is a slow replacement of one set of assumptions with another, and then a final set that she will eventually stop questioning because questioning them would require a stillness the structure does not allow. She opens the first deck. The founders are two engineers, 26 and 29, building something she has to read twice to understand. She reads it twice. She starts writing the note. The queue refreshes. 3 more decks arrive. The machine takes another step forward.